Hi everyone, Abdurrahman Nadia is my name. Over a couple of videos on investment appraisal techniques, in which we have been dealing on how to appraise our investment, how to appraise our project in order for us to know whether those investments are viable in the sense that can the company invest on those projects. Will the project increase the net present value of of the company? How will it better what advantage is the execution of that project to the company? So in answering these questions, we tend to do we use different appraisal techniques. Those that we have under the traditional approach and those that we have under the discounted cash flow approach. So by that, therefore, in determining whether a project is viable or not, there are some costs, there are some cash flow in which we need to put into considerations. Now, the question is, how do we now determine the relevant cash flow to use in making our decision whether to invest in a particular project or not? So this area is very critical for students preparing for examination, in answering any examination, or for any investment appraiser. Not only for students, for financial managers, or anybody that is involved that is appraising an investment. But therefore, we are looking at determining the relevant cash flow. There are some cash flow in which are not relevant to to decision making. Only the relevant cash flow should be used in arriving at the conclusion whether to invest in a particular project or not. So it is only the incremental cash flow that should be considered in making our decision in appraising the project. And therefore, the relevant cash flow are the future incremental cash flow of the organization as a whole, which arises as a result of the project acceptance. Now, what do you mean by this? I said the relevant cash flow are the future incremental cash flow. Look at it, future incremental cash flow. Future, not past. Okay? So those incremental, cash flow that are going to do incur, whether inflow or outflow, in the future, those are the ones that are relevant for decision making. There must also be the incremental, future incremental cash flow. Those are the cash flow that are relevant for decision making. That is, if you are taking up a particular project now, what are the cash flow that we that will accrue as a result of undertaking the project? What are the future incremental cash flow that will accrue as a result of undertaking the project? So those are the elements of cash flow. Those are the characteristics. The characteristics of cash flow that is relevant for decision making. And therefore, in particular, let's now look at some cash flow in which we are going to determine whether they are relevant for decision making or not. So number one is sunk cost. Sunk cost. What is by sunk cost? Sunk is something that is already passed, or has been committed already. You have finished making a decision on that. These are money already spent or committed. These are money already spent or committed. We have already spent it. Past. We have already spent it, or we have committed it already to a particular project, to a particular action. Thus, it is not relevant to the decision. Example of this is research and development cost. Research and development cost. So research and development cost is what is irrelevant for decision making, because whether you go ahead to invest on such a project in which you have make research on, or you did not go ahead to do what to invest on such a project, the cost has been expended already, has been spent already, you have incurred the cost already, irrespective of whether you go ahead and do what and make and invest on such project or venture in which you have spent such a research and development cost. So therefore, some cost is what is totally out of it, is not relevant for decision making. An example is a very good example is what research and development cost. Another cost that is irrelevant that we need to do or to take note of is interest payment. Interest payment. Interest payment, this is the money in which you do what you pay as a result of making use of what this is the charge that you pay as a result of making use of a facility. Take for example a bank loan. If you approach a bank for loan, the bank will give you in consideration in return of what for interest. So therefore, our appraisal techniques is basically based on what? On discounting. And discounting, when we say discounting has already taken into consideration the time value of money, in which interest payment is one of it. Because the element of interest is number one element of interest is that this loan you have taken may not be paid as at when due. That is why the banks normally charge interest on capital. One, because the loan taken may not be paid back as at when due. And secondly, this is a compensation for the use of fund, because the fund will not be available to be spent on any other project in which is going to make return for the bank, for the financing institution. So by that, therefore, the interest element is a compensation for risk and a compensation for time value of money. The risk that they will not be paid back as at when due, and what compensation for not be able to do to use it on other opportunity, which is the opportunity cost. Okay, so since our appraisal technique is based on discounting, the discount factor that we normally use is already embedded. Interest, the element of interest is already embedded in a discount factor. So if you now see an element of interest in a particular question, this interest will be irrelevant for decision making, because the discount value used or the cost of capital used by the company in appraising that project, element of interest is in the cost of capital. Okay, dividend payments. Dividend payment is irrelevant for decision making, because this is just an appropriation of return an appropriation of profits, which has no relevance for decision making. Accounting treatment of cost. There are some treatment given by use in accounting, in which they are not relevant for decision making. Example is depreciation. Depreciation is not useful under decision making, because it's just a way of just setting depreciating an asset in which the value does not economically interpret the use of the asset. So by that, therefore, depreciation is not relevant for decision making when you are determining when you are appraising a project. It's irrelevant. It's irrelevant for decision making. So method of allocating overhead. Those accounting method of allocating overhead is also irrelevant for decision making. Fixed cost. Fixed cost is is irrelevant for decision making, because whether you spend or whether you invest on the project or not, this cost is already there. You are going to do what you are going to pay, you are going to incur the cost irrespective of the level of activity. So anything that does not what form an incremental due to undertaking such an investment project will cease to do what? To form part of what? The relevant cash flow. So at this junction, these are some of the factors to watch out for. These are some of the costs to watch out for when you are determining the relevant cash flow to be used in investment appraisal before you now arrive at a decision. At this point, I would like to do what to call it a class now on investment appraisal. If you have not subscribed to my YouTube channel, kindly click on the subscribe button, share the video, like the button, and like the videos. In the comment section, put your comment. Kindly put your comment there, and I'll be glad to do what? To respond to your comments. So at this junction, we are coming to the end of what? Of investment appraisal, capital investment appraisal. So the next video will be on capital rationing. So kindly watch out for the next video and stay blessed, share the video and subscribe to the YouTube channel if you have not. So I'm leaving you now saying what? Thank you and God bless.